By the time you finish watching this video, you'll understand 9 different ways to generate tax-free income in retirement. And you know what? Stick around to the end where I give you the last tip, which is actually more powerful than all the other 8 put together. Make no mistake, tax-free income can be a game changer. It's almost like getting a 20 to 35% bump in retirement income, depending on your tax bracket. Looked at another way, tax-free income is like having 20 to 35% more in retirement assets. At the end of the day, you're going to end up with more money. Life is good. Often the key to generating tax-free retirement income is shifting money into assets that actually generate tax-free income. So with that in mind, let's get to it. The first idea is a Roth IRA. Roth IRAs can be a fantastic tool to provide retirement tax-free income for the right person. When you contribute to a Roth IRA, you don't get a tax deduction like you would if you made a contribution to a regular IRA or many other retirement accounts. But with a Roth, your withdrawals are tax-free if you comply with the rules. And that basically means you have to wait to reach age 59 and a half before you make the withdrawals. And it also means you have to have the account open for at least 5 years. That means you have to wait 5 years from the start of the tax year you first contributed to the account before you withdraw the funds, if you want those withdrawals to be tax-free. So for example, if your first contribution was made on April 18th of 2020, for example, you could start taking withdrawals on January 1st, 2025. You qualify for tax-free withdrawals because even though you made the first contribution on April 18th of 2020, you can make withdrawals on the first day of the 5th year, which is 1/1/25. You don't have to wait until the anniversary, which is 4/18/25. Now there are some loopholes around the 59 and a half age and 5-year holding period. I suggest you consult with your tax specialist for your own situation. So one way to generate tax-free income in retirement is to fund your Roth while you're working and then take the distributions from the Roth when you retire. The thing is, this strategy is very smart for some people, but not for everyone. It depends on your tax bracket before and after retirement. That's why, again, it's always smart to consult with your tax and financial advisor before making any important financial decisions like these. Still, if your advisor hasn't brought up this idea of the Roth as an option, please talk to him or her about it. Now, besides providing tax-free income, there's another huge benefit to Roth IRAs. There are no mandatory distributions from this IRA after age 72, unlike other retirement accounts. With your normal IRA, you must take taxable distributions after age 72. And that means you must pay the tax on that money which you withdraw. With a Roth, you aren't forced to take the money at any given time. Keep in mind that not everyone can contribute to a Roth. Look at this chart. For tax year 2023, single filers and heads of household with a modified adjusted gross income from at least $138,000 to $153,000 can only contribute a reduced amount. If your modified adjusted gross income is less than $138,000, then you can contribute the full amount. But if you file single and make equal to or more than $153,000, you can't contribute to a Roth IRA at all. This table shows the amount that you can contribute to a Roth if you're over 50 years old. If you're younger, you can also contribute, but the amounts are a little bit reduced. For tax year 2023, married couples filing jointly have an income phase-out range of between $218,000 to $228,000. Therefore, no contributions are allowed if the couple's modified adjusted gross income is equal to or greater than $228,000. Again, those with an income below $218,000 can contribute up to the full amount. If you're married but you file separately, your phase-out range is just $10,000, which is the same amount every year. The good news is, if you have a Roth 401k, those income limits don't apply. Now, we have 8 more ways to cut income tax, but before I dive into the other ways to generate tax-free income in retirement, please make sure to subscribe to our channel And don't forget to smash the notification bell. That way you'll be informed of future updates to this video and future releases of other important retirement income topics. Back to work. IRAs and 401k withdrawals. I just finished telling you about the benefits of Roth IRAs, but in the right situation, regular IRAs and 401ks can be even more powerful. If your income falls significantly after you retire, you'll be in a much lower tax bracket, and you might be able to make withdrawals from your regular IRA and or 401k tax-free. If you can do that, it means you were able to take a tax deduction when your earnings were high, and then you take taxable withdrawals with no or very low tax owed. Pretty sweet. Here's what this looks like. This is a schedule of income tax brackets for 2023. If you have low or no taxable income in a given year, consider making withdrawals from your retirement accounts to take advantage of your low tax situation. Your withdrawal may not be completely tax-free, but you may be able to escape the higher brackets. If your income rises the next year, for example, you can cut back on those retirement account withdrawals. This is an idea that can be especially powerful for people with income that fluctuates from year to year. Municipal bond income. Interest income from municipal bonds isn't taxed at the federal level. Now, it's usually not taxed by the issuing state either if you live there at the time. But city and other local taxes might apply. There are other benefits and drawbacks to owning bonds as we've discussed in prior videos, so please subscribe so you'll be informed when we update those videos. In a stable interest rate environment, municipal bond prices could remain somewhat stable, all other things being equal. And like all bonds, the key is to hold to maturity when they pay off at face value, and that's guaranteed. And bonds are generally considered more conservative than stock market investments, so this could be a good fit for the right investor. Qualified dividends are taxed at rates of 0%, 15%, or 20%, depending on your taxable income and filing status. Non-qualified dividends are taxed at ordinary income rates. Those range up to 37%. So you can see that the key issue here is qualified. What is a qualified dividend? Well, a couple of things. The company that pays the dividend must be domestic or a qualified foreign corporation that trades on the New York Stock Exchange. The distributions must be ordinary dividends. They can't be capital gains distributions or income from tax-exempt organizations. And you must have held those shares of stock unhedged for at least 61 days out of the 121-day period that began 60 days before the ex-dividend date. The 0% rate applies to single tax filers, for example, with taxable income up to $44,625. The 0% rate applies to qualified dividends received by married joint filers for up to $89,250. Let's talk about long-term capital gains. As for capital gains, that income from assets held more than a year is taxed at a peak rate of 20%. But a 0% rate applies to taxpayers who meet the same income caps that govern eligibility for the 0% rate for qualified dividends. We just looked at that. So again, depending on your tax situation, you might be able to sell appreciated assets, pay no or low tax on the gain, and then create the income that you need in retirement. And again, talk to your tax advisor, please. A word of caution on the 0% rate is the gains and dividends might not be taxed at the federal level, but they do increase adjusted gross income, which could increase the tax on Social Security benefits and or other taxes. Also, your state may tax the gains at a different rate. 6. sale of your home. Capital gains on the sale of your primary residence could be tax-free. The IRS exempts up to $250,000 in capital gains from the sale of your primary residence once every 2 years, and if you're married, the exemption jumps to $500,000. In other words, let's say that you're a married couple and you bought your home 10 years ago. You bought it for $500,000, including improvements, and you now sell that home for $1 million. That entire gain of $500,000 comes to you tax-free. You can use that money to generate tax-free income using the ideas that I presented above. Life insurance proceeds. If you are the beneficiary of someone else's life insurance policy, or if you've named others as beneficiaries on your life insurance policies, planning ahead is crucial. And I say that because proceeds from a life insurance policy payout are federally tax-free. And there are other ways to generate tax-free income from life insurance. If you own whole or universal life, you might be able to get tax-free income from those policies as well. I don't generally like these policies as they're very expensive, but if you already own one of these and you're fortunate enough to actually have one that's working out, well, you could tap into the cash value and do that tax-free. Talk to your life insurance agent or financial advisor to see if this describes your particular situation. Also, if you outlive the policy term or you cancel the policy before the term ends, you might be entitled to some tax-free benefits. 529 savings plans. These college savings plans make great estate planning tools, and they also make investment returns tax-free. You can contribute money to a 529 plan and name a beneficiary of the account. Usually a child or a grandchild is named the beneficiary with the expectation that the account eventually will pay for college education. But you can also name yourself as beneficiary, and you can change the beneficiary whenever you want. You don't receive a federal income tax deduction for making contributions, but investment returns compound tax-free in this account. And even better, distributions are tax-free when used to pay for a qualified education expense. The definition of a qualified education expense has expanded over the years and now includes pre-college education expenses as well, up to $10,000 paid to either public or private institutions. It includes computer and internet expenses. They're also allowed. Time for that bonus I promised you earlier. I provided you with 8 tools to generate tax-free retirement income. But here's the thing. You might be thinking that, you don't really need to worry about any of this because, well, your tax or financial advisor, they'll bring the relevant ideas to your attention. You could be right, but you probably aren't. Most tax advisors aren't very proactive. They won't look for opportunities for you to save tax money. They'll just calculate what you owe to Uncle Sam based on your numbers. So if you want to save tax dollars, you have to be proactive. At the very least, bring these ideas to your advisor's attention. Believe it or not, many are not even familiar with some of the ideas that I've presented to you today. For more great ideas on securing your retirement future, make sure to subscribe to our channel and please smash the notification bell. And be sure to look in the description below to this video. You'll see a link to join our Facebook group where you can interact with others about any retirement issue. And also we have links to our free booklets on 10 different retirement issues and topics that will be helpful to you.